In this video, in about 3 minutes, we explain the fundamentals of investing in stocks. The first thing you should understand is the difference between investing and speculating. Speculators bet on prices of stocks going up or down. Investors, on the other hand, play a very different game. They look for companies that are good at earning money for their shareholders, and then they look for an opportunity to buy shares of those companies at reasonable prices. Once they find and buy such shares, they own them for a long term and enjoy the earnings that the company produces. So let's talk about earnings. What you're looking for is companies that are good at earning returns on your investment. What does that mean? Think of a bank for a second. You deposit money into a bank, and then the bank earns interest on it every year that can be somewhere in the range of 1 to 5%. If you don't do anything, the earnings get reinvested in your bank account and continue to grow. Or you can choose to withdraw them. The situation is very similar when you invest in a company. Company takes equity of its shareholders and then earns returns on that equity. For large U.S. companies, that averages around 12% per year. So if you want to invest in good companies, you should look for ones that can earn 18 or more percent per year. The standard accounting name for this is ROE, return for equity, and it's easy to find. And then the company can choose to either retain the earnings, in which case it becomes more valuable and has more money for its operations, or to pay out the earnings to you as dividends. Now you will look at this and say, 18% per year, that's great. How do I sign up? Well, there is a catch. And the catch is that you cannot directly deposit money into companies' equity. It's not like a bank account. You have to buy shares of equity from the previous owners. And because companies are so good at making money, previous owners are going to ask you for a premium, for a markup. So how do you buy equity at a good price? And here we're talking about equity of great companies bought at a good price. Well, you can find out the value of equity by looking at companies' reports. They state it as book value, the value of equity according to their books. And you want to buy shares where the price to book value ratio is somewhere around 1, not too much higher. Another good metric to look at is the price to earnings ratio. How much do you pay in price for $1 of earnings? And you definitely want this to be below 20 or so. If you can't find good opportunities at good prices, don't worry. You can always just wait. Warren Buffett said that good opportunities are like buses. If you miss one, there is always another one coming. So to summarize, if you want to have good results investing, what you're looking for is companies that can earn good returns of 18% or more in returns on equity. And then you want to wait to buy their shares at reasonable prices, such as when price to book value is around 1. And finally, you want to enjoy their earnings for a long time, 5 or more years. If you do this, you will be a great investor.